This is Chuck Carnival. I'm the Chuck in the Markets Up Chuck. And, when I opened the Wall Street Journal early this morning, the headline, really struck me. And, banks face more losses. Regional banks face big losses, I believe is the headline. And, once again, we're all talking about the banking community, and everyone's stressing the negative, and the media just loves to do that. So I thought it might be fun to take a look at Hudson City Bancorp, which has been rated by Forbes magazine in 2007 and 2008 as the best managed bank in America. And the point of the story is, I don't want to get into a political discussion here, but we can talk about whether banks should have been allowed to fail or not, or whether they should have been bailed out or not. But here's a bank that did not take any TARP money. Here's a bank that had, good conservative management of their assets. Here's a bank that was loaning money all the way through the recession. And here's a bank that actually had an extraordinarily profitable year in 2008. And, it's a bank that has basically been built on old-fashioned values. And it's still running as a thrift and running and taking care of its shareholders, taking care of its depositors, taking care of its borrowers. This company offers some of the best rates on mortgages and yet some of the highest yields on deposits with some of the lowest fees. It's really a great little bank. As you can see here from their chairman's message, 2008 marked their 10th consecutive year of record earnings. And the New York Times reported Hudson City is one of the few bright spots in an industry beset with doom and gloom. The real moral of the story here is that sound management strategies and operating results really matter much more than things like the economy or even what the rest of the industry is doing. And that's why I thought it would be so interesting to highlight this extremely well-run financial institution. And since I'm only going to talk about this one company today, I thought it would also be a good opportunity for me to maybe enlighten you a little bit and introduce you a little more deeply into the fundamental research analytical tool that we use, we call FRAT, because it is such a powerful tool. So I'm going to kind of look at Hudson City Bancorp from the perspective of our fundamental analyzer tools since they've gone public. They went public in 1999. By the way, it's over a 140-year-old institution headquartered in New Jersey. As you can see, the earnings growth of this company since it's been a public company has been really extraordinary. Year after year, their earnings have increased very consistently. They've averaged over 20% growth, and by the way, they have one of the strongest balance sheets of any financial institution probably in America. And that's why they, they did not, participate in TARP or any other government bailout program. So the first thing our chart does is it plots the earnings of the company and calculates the growth rate of those earnings. So you can see here Hudson City has compounded earnings. Earnings have gone from 15 cents a share in 1999 to $1.04 a share this year. That's a 20% compounded rate of return or growth rate. The next, I overlay price onto the chart, and you can see that the stock price, these are monthly closing stock prices, the black line here, correlate very strongly to earnings growth. This line, we always look at this line, or I always look at this line as representing the true worth of the intrinsic value of the company. That's kind of the PEG ratio line, the price-earnings ratio equal to the growth rate. So you can also think of this line as 20 times earnings. When you look here, obviously the stock traded at 20 times earnings very consistently. It was overvalued, for much of 2004, 2005, 2006. And then towards the end of 2007, it kind of came back to around a 20 multiple. It was trading at a higher price-earnings ratio here. Then we had this big surge in earnings in 2008, which was extraordinary. This company continued to lend because they ran the bank conservatively and they ran it as a prudent business. They were actually, loaning money when the rest of the banking industry was, frozen. Now, their stock price, however, was not immune to the problems, but it did hold up significantly better than a lot of the other banking institutions. But their price did fall from a high of, the actual intraday high or monthly high for 2008 was $25.05. We only have weekly closing prices, monthly closing prices on this chart. So, it fell from, let's say, 25 and fell to as low as 13. So it did have a significant drop in price, and now it's recovered, from its real low of $10 a share in 2009, which was the lowest the company had fallen to, and it's now up at $12.91. So you can see this strong spike in recovery because here's a company that's really being prejudiced. It's being prejudged as a bank, and therefore the stock value is way down, yet the company's business has been, extraordinary during this period of time. Now I'd like to add dividends to the equation here. The light blue area here, the turquoise area, is dividend income. Now, I want you to remember the dividends come out of these profits. This blue area represents the portion of these earnings that the company pays to its shareholders. And because of its low valuation right now of 13 times earnings, which as you can see is historically low for this company with extraordinary operating results, the company's currently yielding 3.7%, and that's actually higher than you can get on a current 10-year Treasury bond. As I mentioned, Hudson City has a very, very strong balance sheet, one of the best capitalized. I keep saying little bank. It's a $6.7 billion financial thrift, so it's really not that tiny, but it's certainly not as big as some of the behemoths, which of course are the ones that we've suffered all our problems with, the Citigroups and the Bank Americas and so on. As a shareholder in Hudson City Bancorp in a period where the S&P 500, or quote-unquote the stock market lost an annualized 3.9% a year, and I'm measuring that from the period August 31st, 1999 to current. That was through yesterday's close. This company turned $100,000 into $648,740 at 21.2%. Compounded rate of return. When you add dividends in, you can see that the dividend record of this company has been exemplary. They've continued to raise their dividend. In fact, they've had 5 quarters in a row where they've increased their dividend, so their yield has grown and increased very dramatically from when they first started paying a dividend back in 1999. It's actually increased, you could argue 52-fold, which has been extraordinary. So the shareholders of this company, through one of the worst economic environments and worst stock markets we've seen in many, many years, certainly going back more than 1 decade, you see a company that's actually generated a very attractive return to its shareholders, even with a discounted stock price. So that's what the history's been. Let's look at the future a little bit. There's the consensus of the leading analysts, which there are 13 as reported the first call, are forecasting this company to continue to grow at 14.5% a year. That's faster than most banks are forecast. However, I want to point out it's slower than it's historically grown at. But if it does continue to do that, as you can see here by this line, this is simply a calculator. At the current price earnings ratio, this would be a $30 stock by 2014, and you're getting a generous dividend that's increasing every year, to be compensated while you wait. So it's very, very attractive, I believe, at these levels based on just the research that this fundamental analyzer tool plus some basic research that I've done on the company. And then finally, I'd like to introduce one last table that that I use in my calculation when I use this tool. I call this the earnings yield estimator. And the earnings yield estimator simply calculates the mathematical cash flows that an investment of $100,000, I always use that number just for mathematical purposes, would be, and then compare that to investing an equal amount in a Treasury bond. And as of this morning, 10-year T-bonds were at 3.2%. As I mentioned, the dividend yield of Hudson City Bancorp was 3.7. So, assuming that it continues to grow like it has by next year, I'd expect that yield to increase to 4%. And if it did give me a 14.5% earnings growth, my earnings yield would be $8,054 on $100,000, and my dividend would be next year would be $4,027, assuming I continue to get a dividend increase. And that would, if that held true for the next 10 years, according to the forecast, I would end up getting $159,000 in total earnings, which is 5 times as much riskless interest as I was getting in a Treasury bill. I always use this as a barometer. I always want to see the cash flows of the earnings to be higher than I could get on a Treasury bill. But even better with this company, assuming they continue to raise their dividend as they have in the past, and the dividend continues to increase at a rate of 14.5%, which is the forecast growth rate, then I would also get significantly more dividend income, $80,000 in dividend income versus only $32,000 in a Treasury bond. So when you add everything up, this augurs extremely well for a very attractive long-term investment from here, from a company that's rated the best bank in America, that has a very conservative capital structure, and has operated through one of the worst recessions with exemplary numbers. The point is the economy is always going to have an effect. The stock market obviously has an impact, but it always comes down to the individual companies. And here's one of the most beleaguered industries in the entire world, and we have a company that has an extraordinary record for its shareholders and an extraordinary record as an operating business. It didn't need any help from the government. It's continuing to function at a very high level, and this is the kind of company that I believe long-term investors should be seeking out. But as always, you need to do your own research. This is just cursory based on this tool. This has been Chuck Arnold. I hope you enjoyed today's presentation and look forward to talking to you again tomorrow. Thanks for listening.